everybody. Welcome to another episode of the Moving Markets Podcast, the Safe Option Strategies Daily Market Update, where we talk about what happened in the market, how it might have affected your portfolio, more importantly, what's coming up for the rest of the week and for tomorrow, and how those things might affect your portfolio as well, and what you can do to try and profit off of it. Glad to have you here. It is Tuesday, the 13th of February. U.S. stock market has been closed for close to 2 hours now. I'm getting this podcast out just a little bit later than normal. But it's full of good information. Wild day in the market, and it's not very often I do this. And I'm quick to admit when I'm wrong about something, but I'll tell you, if you listen to yesterday's podcast and you listen to today's podcast, we absolutely nailed it, and the markets did exactly what we thought they would do if we got the CPI numbers that we thought could happen, and it was brutal. It was a little bit of a bloodbath today. We're going to talk about that and what I think is going to happen for the remainder of this week, as well as give you some updates on where we're at with some trading. So please enjoy this episode of Moving Markets, and as always, please take a quick minute, subscribe to our Moving Markets or to our Safe Option Strategies YouTube channel. Like this, send a comment on it, give us some feedback on what we can do to improve it. We're always trying to make this as enjoyable and as informational as possible for you, and we'd love your feedback, and we'd love your input, and we'd love your ongoing membership. Enjoy today's podcast. Well, as you can see, the markets had a pretty big sell-off today. The Dow Jones Industrial Average down 524 points, and a couple of different times today. I don't remember exactly how far down it got at the deepest point, but I know it was over 750 points down at one time. The S&P finished 68 points down, almost 69, and the NASDAQ got really beat up, 286, almost 287 points to the downside. And from a percentage standpoint, that is a big percentage. That's bigger than the 1.35 or the 1.37 that the Dow and the S&P respectively sold off. And look, we talked about this yesterday. I'm going to say to a degree we predicted what this was going to do. This is what we anticipated if we got CPI numbers that came in hotter than expected. I took a fair amount of time yesterday talking about the fact that the consensus estimate here was 0.2%, and that if we were up even 0.1% higher than that, it would spell trouble. I said that this estimate was 3. If it was even as little as 0.1% off, which it was 3.1, that would spell trouble. This one off 0.1% at 0.4, and this one off 0.2%. And this is really the number more than anything else. This is the number that the Fed watches as a gauge of inflation. Now, I don't know specifically why I know the reason why they don't look at this number, because they take out food and energy, because those are prices that have a tendency to fluctuate greater from 1 month to the next. One short-term spike in oil prices can throw off a month on the prices of everything, but then it can quickly reverse and go back the other direction. So they tend to focus on what they call the core CPI, which is everything except for food and energy, because of how volatile those things can be. They feel like it skews a month over month or a year over year number. So this is kind of a big deal that this 3.9% means no change from the month before. And never, ever forget, I harp on this all the time. I beat this drum until you're probably sick of it. When we peaked, what I'm going to say, a year and a half ago, when we peaked at 9% inflation, and that was the year-over-year rate of increase, this 3.9% right here is not a reversal of inflation. Inflation has not reversed. Prices have not come down. They are simply going up at only 3.9% instead of 9%. So we're not. I really get ticked off a lot of times at the talking heads in the media, especially the ones that are very partisan in their politics and very obviously partisan in their politics, and how they want to act as though everything is getting better. You should not be feeling inflation anymore because look how far it's come down. Well, the rate of increase has come down. Instead of going up this steep, it's only going up this steep now, but it is still year over year that much higher than it was 2.5 years ago. And it's squarely 100% on the shoulders of Joe Biden and the current administration's policies. Every single thing they have done as far as policy goes has increased the prices of things and not brought them back down. The Fed has got this number somewhat under control compared to where it was a while ago, but it's not going backwards. It is simply slowing down. So that's as much as I'm going to say about that. Here's the situation, quite honestly, with why the markets reacted the way they did to this number today. We've had this narrative for some time now, and it started with some comments Jerome Powell made, I think back in September or October of last year. He made a comment about rate cuts for 2024. And he mentioned that there would be probably a few rate cuts during 2024. And then people started to speculate and people started to try and second guess the Fed and say, oh, there's going to be 5 or 6 rate cuts or 7 rate cuts. And then we had this booming, crazy rally that was just insane through November and December. It wasn't the traditional Santa Claus rally that we get in December. It was a massive upward month for the month of November as well. And this after a market that struggled a little bit in September and October of last year. So the market was moving up very, very strong on this idea that we were going to have at least 3, if not 4, 5, or 6 rate cuts during the 2024 calendar year. And then January started just a little bit wobbly, and then the market sort of caught fire again and accelerated to the upside in January. And once again, all of it was this narrative that the Fed has fixed everything. They have brought inflation down enough that everything is good. Consumer spending stayed strong through November, December, January, even though the warning signs were there about credit card debt and how much money people were putting on credit cards or how they were draining their savings in order to create this strong consumer spending. And so everyone kept thinking life is good, everything is good. Why wouldn't the Fed start cutting rates for us? And you've got a lot of investment advisors and brokers and hedge fund managers and mutual fund managers that took some hits in 2022 and 2023, and they blame it all on the Fed, and they think the Fed overreacted. I'm in the opposite camp. I think the Fed should have done more, and I think they should have stayed with rate cuts and made some of them rate increases. I think they should have made some of them a little bit bigger, and I don't think they should have paused when they did. But I'm in the minority on that camp. But now every bit of news that suggests that inflation is either not going to come down fast enough, or that it might tick its head back up a little bit, or that maybe the consumer is starting to weaken a little bit and show some cracks, anything like that begins to douse the fire of rate cuts and start to create a different narrative about, oh, well, now it's almost a guarantee we're not going to get a rate cut in March. And now it's starting to look like we're probably not going to get a rate cut in May. And then there's a question of how political does the Fed look if they only start cutting rates in July and September, that close to the election. And if they don't cut rates then we can't even get 3 rate cuts before the end of the year because we're down to only a couple more Fed meetings. And then you've got this notion that if inflation creeps its head back up too much, we might have to raise rates again. And for those people who want to see the markets rally on hope for rate cuts, it squashes that reality. And when you get the idea that inflation is going to go higher or at least stay as high as it is and maybe not come down any farther, bond rates start to go up. The 10-year, the 5-year yield starts to go up, and that drives more people into bonds. It's a supply and demand thing. It drives more people into bonds. They pull money out of the stock market, whether it's individual traders like you and I, whether it's brokers, whether it's registered investment advisors, whether it's hedge fund managers, big money managers at Schwab and Goldman Sachs and Merrill Lynch and Citigroup and JP Morgan and all these places. They have to move money out of the stocks and the ETFs and the mutual funds in order to put money into the bonds. And when bond prices are high, people feel like that's a safe bet. That's a good way to tie up some money and know that you'll get at least that percentage on it. And people are willing to put a portion of their money there. So that's what causes the market to sell off. Now, I want to be really, really clear about. All right. So I had a little bit of time that I thought I was recording and my recording had stopped. So I'm going to come back to this, and I cannot even erase the marks that are on here right now and clean up this view for you like I would like to. So let me go back to the conversation I was having about what to expect the rest of this week. Tomorrow, I could make a case for a big rebound in the market, something that really drives the market up strongly, or a continued sell-off. And let me paint the picture for what would cause either of these two things. And right now, I am split 50-50 on which of these things is more likely to happen. Tomorrow morning, when the markets open, I think initially things are going to be down a little bit. There could be some earnings reports going on tonight that could change that. Although the one that I was watching most closely after the close today was Airbnb, and they were taking a big hit after market. So I'm not overly excited about what's going on there. I think you're going to see futures down tomorrow. And when the market opens and starts to trade, if it in fact trades to the downside, you're going to get one of two things happening. The indexes, the Dow, the Nasdaq, the S&P, they're going to hit a level of support. It may be the 20-day moving average. It may be a more technical level of support based on some prices, some recent levels of resistance that have now become the next level of support if things start to reverse and go to the downside. If you see the indexes push through and past those levels of support, the sell-off is going to accelerate. You're going to get an algorithm effect where predetermined sell points that have been programmed in are going to trigger and start pushing the market down farther, and maybe create a capitulation situation where people are just kind of exasperated. They give up and say, sell everything and we'll wait for the bleeding to stop and we'll get back in. If instead you get a bounce off of one of those levels of support and things start to look like they're going to hold that level of support, I believe you could see the FOMO effect move in, and the buy the dip mentality not even wait for a full day after what happened today. There's a lot of people that looked at what happened in November. They looked at what happened in December. They looked at what happened in January. They didn't see the best opportunity to get into any of the Magnificent Seven stocks or to get into an index fund or an ETF. And they don't want to be left out again. They don't want to miss the next opportunity. For some people, that opportunity is the dip we had today. And any sign that things are stabilizing and holding a level of support would cause a lot of money that left the market today to jump back in and reposition into those companies that they think are going to benefit the most from this buy the dip. FOMO is a powerful thing, the fear of missing out. And it used to be that you would get a full week or a couple of weeks or a full month of a downward slide. And then people would feel like that's the buy the dip time. Now I'll get back in and drive this thing up. And I'm telling you, it just doesn't happen that way like it used to. People are much quicker to react and to buy that next dip and not take a chance that they miss out on the new one like they did the last one in terms of the rally. So FOMO is a powerful thing, and it has the ability to really drive this market up fast and to really make it just scream to the upside. So you got to be watching for either one of them to happen. Now, I believe, it's my opinion, that a combination of the retail sales report, the Philadelphia Fed, and a couple of these other indicators that normally by themselves are not real big market movers. But I think if you get two or three of those reports all painting sort of the same picture that the CPI did this morning. In other words, the consumer weakening a little bit, inflation being more sticky, manufacturing falling off, some chinks in the armor of what people have felt like is a resilient economy. If these reports on Thursday morning paint a different picture, it doesn't matter if we have that big rally tomorrow that is the buy the dip thing. these reports on Thursday and this PPI report on Friday, which I think is going to tell the same story that the CPI report did today, if a combination of those things are in line with what I think they're going to be, no matter what happens tomorrow, you're going to see Thursday and Friday sell off in a pretty strong way. I would be very cautious entering any new trades from this point to the rest of the week unless you get into something very non-directional. I would not try to predict, especially for tomorrow, if this market is going to take off to the upside and gather some steam and get back most of what it gave up today, or if it's going to continue with a as deep or deeper a drop as what it had today. And again, I'm 50-50. I could go either way. But regardless of what happens tomorrow, I'm anticipating Thursday and Friday both being very bearish days. And I think we're in for the worst week so far of this calendar year. I'm not hoping for that to last. I'm honestly hoping that FOMO will kick in. If not tomorrow, by the end of this week and early into next week, I hope that FOMO kicks in and we see things being pushed back up in a strong way. And I really deep down believe that is what's going to happen. But in the meantime, be very cautious going into the rest of the week. Thank you once again for joining us in this presentation. We'll be back tomorrow within an hour or two after the market closes. And every day you join us on this Moving Markets podcast, we appreciate it. Have a great rest of your day. Bye-bye.